If you want to know when the next global conflict is coming, stop watching the aircraft carriers. Military assets are theater. They get deployed for exercises. They get repositioned for signaling. They can be recalled to port in 72 hours. Aircraft carriers are designed to be seen. They are meant to make headlines. But if you want to know what a superpower actually intends to do, if you want to know whether they are preparing for an irreversible break from the current world order, you have to follow the money. Not stock prices, not currency flows, sovereign debt. Debt is heavy, debt is slow. You cannot offload hundreds of billions of dollars in government bonds without the entire market noticing. It takes months, sometimes years. And if you try to do it fast, you crash the price and lose a fortune. So when the second largest economy on the planet starts dumping the debt of its primary rival at a speed that defies every rule of asset management, they are not rebalancing a portfolio. They are clearing the decks. Last month, the U.S. Treasury Department released its latest international capital data. Most financial journalists glanced at the headline number and moved on. But buried in that report is a figure that should concern every single person holding dollars, dollar-denominated assets, or any investment tied to the stability of the American financial system. China's holdings of U.S. Treasury bonds have collapsed to $688 billion. That number means nothing without context. So let me give you context. This is the lowest level of Chinese ownership of American debt since November 2008. We have erased 16 years of financial integration between the two largest economies on Earth, and the speed of the recent selling suggests Beijing is no longer concerned about market stability. They want out, and they want out now. The question is why? And the answer reveals something far more dangerous than a trade war. Let me walk you through the numbers, not the summary, the actual data. The Treasury International Capital Report, known as the TIC report, is one of the most important documents in global finance. It tracks every foreign purchase and sale of U.S. securities. It tells you exactly who is buying American debt and who is selling it. Most people have never heard of it. Most financial journalists skim the top line and move on. But if you want to understand the real flows of global capital, this is where you look. According to the October 2025 data, China's official holdings of U.S. Treasury securities fell to $688.7 billion. That is down from $700.5 billion in September. They shed nearly $12 billion in a single month. Now, $688 billion still sounds like a large number. It is. But numbers only matter in context. At the peak in November 2013, China held $1.32 trillion in U.S. Treasuries. They were the largest foreign creditor to the United States. They funded American deficits. They bought the bonds that kept interest rates low. Every time the U.S. government needed to borrow money, Beijing was there with an open checkbook. That relationship is over, from $1.32 trillion to $688 billion. China has liquidated 47% of their peak holdings. They have sold over $630 billion worth of American government debt, and the pace is accelerating. In 2024 alone, they reduced holdings by roughly $50 billion. In the first 10 months of 2025, they sold another $70 billion. Month after month, the number drops. September to October, another $12 billion gone. Here is what makes this unusual. Throughout late 2024 and 2025, the U.S. bond market was under pressure. Interest rates were elevated. Bond prices, which move inversely to yields, were depressed. Anyone selling treasuries during this window was selling at a loss. In asset management, there's a basic rule. You do not sell a depreciated asset unless you have to. You hold it until prices recover. You wait for a better exit point. China did not wait. They sold into weakness. They accepted the loss. They prioritized speed over price. There are only two reasons a sophisticated investor sells a depreciated asset at a loss. Either they are facing a liquidity crisis and need cash immediately, or they believe the asset is about to become worthless. China is not facing a liquidity crisis. Despite their property market problems, they still run a trade surplus north of $800 billion annually. They are sitting on over $3.3 trillion in foreign exchange reserves. They have cash. So the only conclusion that fits the data is strategic. Beijing has decided that U.S. Treasury bonds are no longer a store value. They view them as a liability, and they are getting out as fast as they can without completely crashing the market. The question is, what changed? And to answer that, we need to go back to February 2022. February 24th, 2022, Russia invades Ukraine. Within 48 hours, the United States and European Union executed a financial strike that rewrote the rules of the global monetary system. They froze $300 billion in Russian central bank reserves. These were not oligarch assets hidden in offshore accounts. This was sovereign money. Official reserves held by the Russian state in custodial accounts in New York, London, Frankfurt, and Brussels. Money that Russia believed was untouchable because it sat in the safest, most liquid financial instruments on Earth. U.S. Treasuries, European government bonds, dollar and euro deposits. Russia thought that money was safe. It was not. With a few keystrokes, Western governments immobilized half of Russia's foreign exchange reserves. They did not seize the assets outright. They did not need to. They simply made them inaccessible. Russia could see the money on a screen. They could not spend it, move it, or use it. Beijing watched this happen, and they understood immediately what it meant. If China makes a move on Taiwan, if the South China Sea conflict escalates, if relations deteriorate beyond a certain threshold, every dollar China holds in American custody becomes a hostage. The $688 billion still sitting in U.S. Treasuries is not an asset. It is a liability. It is leverage that Washington holds over Beijing. The moment serious sanctions are applied, that money goes to zero. This is not speculation. This is the explicit lesson of 2022. The United States demonstrated that it will weaponize the financial system against geopolitical rivals. It froze Russian assets without a formal declaration of war. It acted within days of the invasion. There was no warning. There was no negotiation. There was just a switch, and the money was gone. China's leadership drew the obvious conclusion. If you hold assets inside the American financial system, you hold them at America's pleasure, and America has shown it will revoke that privilege the moment strategic interests demand it. So China is getting out. They are not waiting for a crisis. They are not waiting for the perfect price. They are liquidating now while the exit door is still open. Every month they hold those bonds is another month of exposure. Another month where Washington could decide that Chinese reserves are the next target. The 10 or 15% loss they are taking on these bond sales is the cost of insurance. They are paying a premium today to avoid a 100% loss tomorrow. Think about it from Beijing's perspective. If you believe there was a meaningful probability that your U.S. assets could be frozen within the next 5 years, would you hold them for an extra 2 points of yield? Or would you take the haircut and convert them into something that cannot be confiscated? That is the calculation China is making. And the math only works if they believe the probability of confrontation is high. This is not a portfolio adjustment. This is a burn notice. They are dismantling the financial architecture that connected the two largest economies on Earth for the past 2 decades. And they are doing it with a speed that suggests they are operating on a timeline. The question now is, where is this money going? And who is stepping in to absorb the flood of bonds that China is dumping onto the market? When the second largest holder of your sovereign debt decides to dump hundreds of billions of dollars onto the open market, basic economics says the price should crash. Supply floods the market, demand stays flat, prices fall. In the bond world, falling prices mean rising yields. Interest rates spike, borrowing costs explode. If market forces were operating normally, China's exit should have pushed U.S. Treasury yields significantly higher. Mortgage rates would climb. Corporate borrowing costs would surge. The interest payments on America's $36 trillion national debt would become even more unmanageable. But that has not happened. Rates have risen, yes, but the market has not collapsed. The system is not broken. Why? Because as China steps out, the allies are stepping in. Look at the October 2025 TIC data. While China's holdings dropped to $688 billion, the United Kingdom's holdings rose to $877.9 billion. That is a record high. In September, they held $864.7 billion. In 1 month, the UK added $13 billion in US Treasuries. The UK has now surpassed China as the second largest foreign holder of American debt. Japan remains first at $1.2 trillion, but Britain, an economy roughly 1/6 the size of China, is now carrying nearly as much US debt as Beijing. Think about that for a moment. China accumulated its treasury holdings over decades by running the largest trade surplus in human history. They earned those dollars by manufacturing goods for American consumers. Real products, real exports, real cash flow. The UK does not have that. Britain runs a trade deficit. They are not swimming in surplus dollars from exports. So where is the money coming from? The answer is the City of London. The UK figure in the TIC report does not represent the British government buying bonds with tax revenue. It represents the London financial system acting as a clearinghouse, hedge funds, custodial accounts, institutional flows routed through UK-based entities. Then there is Belgium. Belgium's holdings fluctuate between $320 and $370 billion depending on the month. Belgium is a country of 11 million people with a GDP smaller than Pennsylvania. They are not buying $350 billion in US Treasuries with Belgian savings. Belgium is home to Euroclear, one of the largest international securities depositories in the world. When you see Belgium buying US debt in the TIC report, you are looking at a proxy. Other central banks, sovereign wealth funds, and institutional investors routing purchases through Brussels to mask their activity. The surge in UK and Belgium holdings, occurring at the exact moment China accelerates its selling, suggests coordination. This is not coincidence, this is policy. Washington is leaning on its allies to absorb the supply that China is dumping. The message is clear. If you do not step in and buy these bonds, the Treasury market breaks. If the Treasury market breaks, interest rates spike globally. If interest rates spike, your economies suffer too. So open your checkbooks. This is financial conscription. The G7 is being drafted into service as the buyer of last resort. Japan has added to its holdings despite fighting its own currency crisis. The yen has been under pressure for 2 years. The Bank of Japan has spent billions defending it. And yet they continue buying U.S. Treasuries because the alternative is worse. The UK has pushed its holdings to record highs despite its own fiscal problems. They are leveraging their position as a financial center to act as a shock absorber for American debt markets. But here is the problem with this arrangement. It has a ceiling. China could buy treasuries indefinitely because they were the factory of the world. They earned real dollars through real economic activity. The capacity was almost unlimited. The UK and Europe do not have that capacity. They are already struggling with their own debt burdens. Their economies are growing slowly. Their energy costs are elevated. Every dollar they allocate to buying U.S. treasuries is a dollar not available for domestic investment. Washington is draining liquidity from its own allies to keep the treasury market stable. It is weakening the periphery to save the core. And China knows this. They understand that the absorption capacity is finite. Every $1 billion of bonds they dump forces the Western financial system to find $1 billion of liquidity to buy it. It is a war of attrition fought with balance sheets instead of bullets. The allies can hold the line for now, but for how long? When China sells a U.S. Treasury bond, the transaction settles in dollars. The People's Bank of China receives a credit in a custodial account. Digital money, entries on a ledger. But China does not want dollars. Dollars are the problem. Dollars are traceable. Dollars are sanctionable. Dollars sit inside a financial system that Washington controls. So the question becomes, what is China doing with the proceeds of this $630 billion liquidation? They are not buying euros. The Eurozone is a strategic vassal of the United States. European assets carry the same confiscation risk. They are not buying yen. Japan is a treaty ally with American military bases on its soil. They are converting paper into physical reality. They are buying things that cannot be frozen with a keystroke. Start with gold. The people. The Bank of China has purchased gold for 13 consecutive months as of November 2025. Official reserves now stand at 2,305 tons. That is 12 million troy ounces. Gold now represents 8.3% of China's total foreign exchange reserves, up from 5.5% at the end of 2024. But the official numbers are almost certainly an undercount. The World Gold Council estimates that unreported central bank buying, most of it attributed to China, reached 118 tons in the third quarter of 2025 alone. That is a 55% increase year over year. Independent analysts tracking Shanghai Gold Exchange withdrawals and import data estimate China's true gold reserves exceed 5,400 tons, more than double the official figure. Gold is the ultimate anti-dollar asset. It has no counterparty risk. It cannot be frozen by SWIFT. It does not sit in a custodial account in New York. When you hold physical gold in a vault in Shanghai, no foreign government can touch it. By swapping treasury bonds for gold, China is converting credit-based reserves into collateral-based reserves. They are moving from promises to metal. Now look at oil. China imports over 70% of its crude. This is their strategic vulnerability. In a conflict, the U.S. Navy could blockade the Strait of Malacca and starve China's economy within months. Beijing's response has been the most aggressive oil stockpiling campaign in history. According to U.S. Energy Information Administration data, China added approximately 900,000 barrels per day to its reserves during the first 8 months of 2025. That is nearly 1 million barrels daily going into storage rather than consumption. Total Chinese oil reserves, combining strategic and commercial stockpiles, now exceed 1.2 to 1.5 billion barrels depending on the estimate. K-Peeler monitoring systems put the figure at 1.5 billion. Energy Aspects estimates total storage capacity at 2 billion barrels. At current import rates, China has enough oil stockpiled to cover 120 days of imports. That exceeds the International Energy Agency's 90-day standard by a wide margin. And they are not stopping. State-owned enterprises, Sinopec and CNOOC, are constructing 11 new storage sites that will add another 169 million barrels of capacity by 2026. The government passed new legislation in January 2025, requiring private refiners to maintain strategic reserves under state supervision. China's crude imports rose 2.6% in the first 9 months of 2025, despite weak domestic fuel demand. They are not buying oil to burn. They are buying oil to store. This stockpiling has supported global oil prices in the $60 to $70 range, despite what should be an oversupplied market. China is absorbing surplus barrels that would otherwise crash prices. The moment they stop buying, that floor disappears. Then there is food. China produces 20% of global GDP, but has only 7% of the world's arable land. Food security is an existential concern for Beijing. According to USDA data, China holds approximately 69% of the world's corn reserves, 60% of global rice stocks, and 51% of wheat inventories. They have accumulated enough grain to feed 1.4 billion people for over a year without a single import. In March 2025, Beijing raised its budget for stockpiling grain, edible oils, and strategic materials by 6.1% to 131.66 billion yuan. That is $18 billion allocated specifically to hoarding food and resources. China's grain reserves are at what officials call a historical high level. They have more than 5,900 emergency food storage facilities, 6,900 emergency processing plants, and 59,000 distribution nodes across the country. They are trading yield for calories. Treasury bonds pay interest. Grain stockpiles cost money to store, but grain keeps you alive when supply chains collapse. Now step back and look at the pattern. Gold, oil, grain, copper, rare earths, lithium. China is systematically converting financial claims, denominated in dollars, into physical commodities that exist outside the Western financial system. They are selling assets that can be frozen and buying assets that can be burned, eaten, or forged into weapons. This is not portfolio diversification. This is preparation. A nation that plans to remain at peace keeps its wealth in efficient, interest-bearing instruments. It maximizes return on investment. A nation preparing for conflict converts financial wealth into strategic stockpiles. It accepts negative real returns in exchange for survivability. Storing 1.5 billion barrels of oil pays no interest. Holding 5,000 tons of gold generates no yield. Warehousing half the world's grain costs billions annually in storage and maintenance. China is accepting those costs. They are willingly taking a lower financial return today to ensure they cannot be strangled tomorrow. The money leaving U.S. Treasuries is funding this buildup. Every bond they sell finances another shipment of crude, another gold bar, another warehouse of wheat. They are using the proceeds from the old system to build the bunker for whatever comes next. So where does this end? Right now, the system is holding. China sells, the allies buy. Treasury yields stay elevated but manageable. The bond market bends but does not break. But this equilibrium is artificial. It depends on the UK, Japan, Belgium, and other G7 members continuing to absorb supply indefinitely. And that assumption has a fatal flaw: capacity. China accumulated treasuries over 20 years by running the largest export machine in history. They earned real dollars by making real things. Their buying capacity was a function of economic output. The allies absorbing China's exit do not have that advantage. They are not running trade surpluses. They are not accumulating foreign exchange reserves. They are buying U.S. debt with borrowed money, leveraged positions, and political willpower. Political willpower runs out. Look at Japan. They remain the largest foreign holder of U.S. treasuries at $1.2 trillion. But Japan has a problem. The yen has been under severe pressure. It weakened past 160 to the dollar multiple times in 2024 and 2025. The Bank of Japan has spent tens of billions defending the currency. Here is the trap. To defend the yen, Japan needs to sell dollar assets and buy yen. The largest dollar asset Japan holds is U.S. Treasuries. If the yen crisis intensifies, Japan will be forced to liquidate the same bonds they have been accumulating. If Japan joins China as a net seller, the game changes completely. Watch the yen. If it crashes toward 170 or 180 to the dollar, if Japanese government bond yields spike, it means the largest holder of U.S. debt is about to become a forced seller. That is the tripwire. The UK faces its own constraints. In September 2022, the British bond market nearly collapsed during the LDI crisis. Pension funds using leveraged strategies were forced into emergency liquidations. The Bank of England had to intervene with emergency bond purchases to prevent a systemic meltdown. That was a warning. The UK financial system is not infinitely elastic. If domestic conditions deteriorate, if gilt yields spike, if the pound comes under pressure, the UK will prioritize its own stability over absorbing American debt. The Belgian position is even more opaque. Euroclear is a clearinghouse. The money flowing through Brussels represents other actors masking their activity. If those underlying buyers lose confidence or face their own liquidity needs, the Belgian bid disappears overnight. This is the fragility of the current arrangement. The buyers propping up the Treasury market are not doing it because U.S. debt is an attractive investment. They are doing it because Washington is applying pressure and because the alternative is a disorderly collapse that hurts everyone. But coerced buyers are unreliable buyers. They stay in the trade until they cannot afford to. Then they exit all at once. Now consider what China knows. Beijing understands that the absorption capacity is finite. They understand that Japan is vulnerable to a currency crisis. They understand that the UK nearly broke 2 years ago. They understand that Europe is struggling with slow growth and elevated energy costs. Every month China continues selling, it drains liquidity from the Western financial system. Every $1 billion the Allies spend buying treasuries is $1 billion not available for domestic investment, infrastructure, or defense. This is economic warfare conducted through bond markets. China is forcing the West to choose between letting Treasury yields spike or cannibalizing their own economies to prevent it. And the longer this continues, the weaker the periphery becomes. At some point, the absorption stops. Maybe Japan breaks first. Maybe a UK fiscal crisis forces gilt sales that cascade into Treasury sales. Maybe European banks face a liquidity crunch and pull back from dollar assets. When that happens, when the coordinated bid disappears, there's only one buyer left: the Federal Reserve. The Fed will have no choice but to step in as the buyer of last resort. They will announce some form of yield curve control. They will cap long-term rates by committing to buy unlimited quantities of Treasury bonds, and they will pay for it by printing money. This is the endgame China is forcing. Either the Allies exhaust themselves propping up the Treasury market, or the Fed monetizes the debt and debases the dollar. Both outcomes benefit China. In the first scenario, Western economies weaken themselves through capital misallocation. In the second scenario, the dollar loses purchasing power and China's hard assets appreciate. Beijing is not trying to win a single battle. They are trying to force the United States into a series of bad choices that compound over time. The $688 billion they still hold is not a vote of confidence. It is the remaining inventory they have not yet liquidated. Every month that number drops, the pressure on the system increases, and the clock is ticking. So, how do you position for a world where the largest buyer becomes the largest seller? You follow the signal, not the narrative. The narrative says Treasury bonds are safe. The narrative says the dollar is the reserve currency. The narrative says the system is stable because it has always been stable. The signal says China is exiting. The signal says they are taking losses to do it. The signal says they are converting dollars into gold, oil, and grain as fast as they can move the money. When the narrative and the signal diverge, follow the signal. Here's the framework. First, shorten your duration. If you hold bonds, you need to understand duration risk. Duration measures how sensitive a bond's price is to changes in interest rates. Long-term bonds have high duration. A 30-year Treasury can lose 20% of its value if rates rise by 1 percentage point. The structural pressure on long-term rates is upward. China is selling. The deficit is expanding. The pool of price-insensitive buyers is shrinking. Even if the Federal Reserve cuts short-term rates, the long end of the curve is set by supply and demand, not Fed policy. If China continues selling, if the Allies eventually tap out, long-term yields must rise to attract new buyers. Rising yields mean falling prices for anyone holding long-dated bonds. Do not own 20-year or 30-year Treasuries. Do not own bond funds concentrated in long duration like TLT. These are the instruments most exposed to the dynamics we have discussed. If you need yield, stay short. Treasury bills with maturities of 3 to 6 months carry almost zero duration risk. They function as cash equivalents. They are liquid. They reprice quickly as rates change. Be like China. Stay liquid. Stay short. Do not lock your capital into 30-year obligations with the government fighting an economic war. Second, own what China is buying. China is selling paper to buy physical assets. They are accumulating gold, oil, copper, grain, and strategic minerals. They are doing this despite the storage costs, despite the zero yield, despite the logistical complexity. Ask yourself, why? If the second largest economy on Earth, with some of the most sophisticated financial analysts in the world, has decided that physical commodities are a better store of value than Treasury bonds, that is information. You do not need to build an oil reserve in your backyard. But you can own the companies that produce these assets. If China is hoarding gold, consider exposure to gold miners or physical gold ETFs. If China is stockpiling copper, look at the producers extracting it from the ground. If China is filling strategic petroleum reserves, the companies pumping that oil benefit from sustained demand. Commodities serve a dual purpose in this environment. They provide a hedge against dollar debasement if the Fed is eventually forced to monetize the debt. And they represent the asset class that a major global power has decided to prioritize over financial instruments. Follow the flow of capital. It is moving from paper to physical. Third, watch the warning signals. You need to know when the current arrangement breaks. There are specific indicators that will flash before the system cracks. Watch the Japanese yen. Japan is the largest holder of U.S. Treasuries. They are also fighting a currency crisis. If the yen collapses toward 170 or 180 to the dollar, Japan may be forced to sell treasuries to defend their currency. That turns the largest buyer into a seller alongside China. Watch Japanese government bond yields. The Bank of Japan has maintained yield curve control for years, capping 10-year JGB yields. If that cap breaks, if Japanese yields spike, it signals the BOJ is losing control. Capital will flee Japanese bonds, and the cascade effects will hit treasury markets within days. Watch the British pound. The UK has pushed treasury holdings to record highs. But if the pound weakens sharply, if UK gilt yields spike like they did in September 2022, Britain will prioritize domestic stability over absorbing American debt. The UK bid disappears. Watch credit spreads. When stress enters the system, the gap between Treasury yields and corporate bond yields widens. If you see investment-grade spreads blowing out while Treasury yields rise simultaneously, it means the safe haven bid is failing. Money is not flowing into Treasuries during stress. That is a structural break. These indicators give you lead time. The system will not collapse overnight. There will be warnings: currency stress, yield spikes, liquidity crunches in peripheral markets. When you see these signals aligning, reduce risk, raise cash, move further into hard assets. Do not wait for confirmation from financial media. By the time the headlines catch up, the move is already over. Fourth, understand what you own. Most portfolios are built on assumptions that no longer hold. The 60/40 portfolio assumes bonds provide ballast when stocks fall. That worked when inflation was low and rates were falling. It does not work when inflation is sticky and the marginal buyer of treasuries is disappearing. Target date retirement funds assume treasury bonds are risk-free. They are not. They carry duration risk, inflation risk, and now confiscation risk if you happen to be on the wrong side of geopolitical tension. Dollar-denominated assets assume the dollar maintains purchasing power. That assumption depends on the Fed not being forced into large-scale debt monetization. Examine your holdings, understand the embedded assumptions, stress test them against a world where China's exit accelerates, where allies reach their absorption limits, where the Fed becomes the buyer of last resort. If your portfolio cannot survive that scenario, adjust now while the exit is orderly. Do not wait until everyone else reaches the same conclusion. Let me bring this back to where we started. $688 billion. That is not just a number in a government report. It is a signal. It is the second largest economy on Earth telling you, through actions rather than words, that the financial architecture of the last 40 years is ending. China held $1.32 trillion in U.S. Treasuries at the peak. They have liquidated nearly half. They sold into a weak market. They accepted losses. They prioritized speed over price. That is not how you manage a portfolio. That is how you exit a burning building. And look at where the money went. Not into euros, not into yen, not into any paper asset controlled by the Western financial system. Gold, oil, grain, copper, physical commodities that cannot be frozen, cannot be sanctioned, cannot be deleted with a keystroke. China watched the United States freeze $300 billion in Russian reserves and learned the lesson. Any asset held inside the American financial system is held at America's pleasure, and that pleasure can be revoked overnight. So they are leaving, methodically, deliberately, on a timeline that suggests they know something about the next 5 years that the rest of the market has not yet priced in. The current stability is an illusion. The bond market holds because the UK and Japan are absorbing the supply China is dumping, but they are doing it with borrowed money and political pressure, not economic strength. That arrangement has a ceiling, and every month China keeps selling, that ceiling gets closer. When the absorption capacity runs out, there are only two outcomes. Either Treasury yields spike to levels that break the U.S. economy, or the Federal Reserve prints trillions to monetize the debt. Both outcomes devalue the dollar. Both outcomes benefit hard assets. Both outcomes reward those who followed China's lead and converted paper into physical reality. The market is no telly pricing this. Pension funds still treat treasuries as risk-free. Retirement accounts still assume bonds provide safety. Financial advisors still recommend the 60/40 portfolio, as if the marginal buyer of American debt is not disappearing in real time. They are looking at the aircraft carriers. They are watching the theater. The real signal is in the capital flows, and the capital is flowing out. China is not making a market call. They are not speculating on interest rates. They are making a geopolitical judgment that the U.S. Treasury bond is no longer a safe store of value. They are betting that holding dollars inside the American system is a risk they cannot afford. If the most sophisticated, most informed, most strategically calculating government on Earth has reached that conclusion, you need to ask yourself a simple question. Why are you still holding what they are selling? The divorce is finalized. The assets are being divided. One side is taking the paper. The other side is taking everything that is real. Choose your side carefully.